Hey everyone, welcome back to Corporate Decoder, the place where we dive deep into the world of corporate filings and try to make sense of all the financial jargon. Today we're cracking open a prospectus, which is like the ultimate sales pitch for a new investment. This one comes with a few red flags that might leave you feeling a little queasy, and it makes sense to know about them. What's it about? It's all about StepStone Private Credit Income Fund, a company that wants your money so they can invest in private credit. But as good old Ben Franklin once said, an investment in knowledge pays best. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below with very smart people making amazing opinions about finance for free. First, let's talk about what the StepStone Private Credit Income Fund actually does. Basically, they want to give you current income with a little bit of long-term capital appreciation on the side. Capital appreciation on the side. Capital appreciation is just a fancy way of saying we hope your investment grows over time. How do they plan to do that? By investing in, you guessed it, private credit. This means lending money to private companies. These aren't big, publicly traded companies. It's lending to smaller businesses that might not be able to get loans from a regular bank. And they plan to use a kind of multi-lender approach, relying on other companies. They call them investment partners, find these lending opportunities for them. Now for the average Joe and Jane to get a piece of this action, you're looking at shelling out $25,000 in the S&D shares, but here is the kicker. For the iShares, $1 million is the starting line, and in increments of 100K afterward, which is pretty insane. Okay, let's get into the nitty-gritty, the part everyone loves to hate, fees. This prospectus lays out all the ways they're going to be taking a cut of your investment, but the main ones are sales load for Class S shares. It's a maximum of 3.5% right off the bat. It's a one-time upfront fee, meaning they take it before your money even starts working for you. Then there are ongoing distribution and shareholder servicing fees. Class S will have annual fees of 0.85% right off the bat. It's a one-time upfront fee, meaning they take it before your money even starts working for you. Then there are ongoing distribution and shareholder servicing fees. Class S will have annual fees of 0.85% right off the bat. It's a one-time upfront fee, meaning they take it before your money even starts working for you. And then there are ongoing distribution and shareholder servicing fees of annual fees of 0.85% right off the bat. It's a one-time upfront fee, meaning they take it before your money even starts working for you. And then there are ongoing distribution and shareholder servicing fees of annual shareholder servicing fees of 0.25%. Yeah, and that's not all they got either. These companies also take management fee, a monthly investment management fee of 1.15% on an annualized basis. So every year they're taking 115% on an annualized basis. So every year they're taking 1.510. It's like if the investment people make you money, they steal some of your earnings. If you've put 10,000 into this example, the management and incentive fees are costing you 200 GBP per year. Total annual fund operating expenses before fees waivers are 5.81% on Class S, 5.21% on Class D, and 4.6% on Class I. I'll add, luckily there is an expense where they will waive some fees. All expenses are capped around 1% to make it look a little better. The example goes on stating that for 1 year, the investment will basically erase all earning, and over a few years they eat a hefty portion of it. Now let's talk about a tool they may use to try to boost those returns, leverage. This is just a fancy word for borrowing money and investing with it. The fund is allowed to borrow in order to generate income, but it has to follow the Investment Company Act of 1940, which restricts their borrowing to no more than 33% of the fund's total assets. The fund has a current line of credit with the JP Morgan Bank for a whopping $250 million US. Now, the effect of borrowing is that it can amplify both your gains and your losses. If the investments do well, you make more money than you would have without borrowing. But if things go south, you lose even more money. They conveniently provided a table showing what would happen per share at percentage rates, such as if assumed the market went down 10%, that can equate to an actual loss of negative %1. To the investors, this is where they tell you all the things that could go wrong in big capital letters. Market conditions. The first point is that general economic and market conditions go well or sideways. Its influence is massive. The fund is a closed-end shop of an interval fund. It's not intended to be a typical open trade investment. There is no trading it on the secondary market, and the company says none will rise in the foreseeable future. They will only give money back when you sell the shares quarterly. only 5.25%, and even that is a problem because you can't be guaranteed that the amount you want to sell will be bought if the total proposed sell is higher than what the company wants to rebuy. The company relies on third-party managers. If those managers can't bring them sufficient investments, the whole thing slows down. You don't want all that capital frozen and unused, which makes investors lose out. Since this fund makes its money by lending to smaller companies, it's worth noting that these types of arrangements pose a higher risk than working with established, stable businesses. Private organizations suffer from diminished access to capital and more. Loans in the market may consist of loans that do not contain financial maintenance covenant. These loans do not require the borrower to maintain debt service or other financial ratios. The company says that only small portions of the fund's portfolio will be comprised of these types of riskier loans. Be careful to never trust what companies say. The fund expects to may invest directly or indirectly in securities and other obligations of companies that are in special situations involving significant financial or business distress, including companies involved in bankruptcy or other reorganization and liquidation proceedings. They are not kidding around because that is insane. Our investments may be concentrated in specific geographic regions. This focus may constrain the liquidity and the number of portfolio companies available for investment. What this means is this company is pretty niche and there is always a higher chance of problems with the neck of the woods where they focus, which gives a smaller chance of a solution if something goes wrong. Since StepStone buys into other private investment funds, that means 2 layers of fees. Management fees you pay to StepStone, plus whatever fees those funds are charging too. This can take a serious bite out of your returns. It is worth mentioning the share outstanding. Class S is almost nothing. The D shares are similarly as small, but look at all the I shares available. This shows the kind of clientele they are after and how this fund will be managed. Alright, let's dig into the folks running the show. StepStone Private Wealth is the main advisor and their job is to oversee everything and make sure the fund is running smoothly. They bring in another company, StepStone Private Debt, as the sub-advisor. These are all affiliates of the main StepStone company. These companies can then be in conflict with one another. The advisors, some of their employees may have an actual and potential conflict of interest. The company from their own resources may also pay third-party securities, etc. in order to increase money into their system, all while increasing the customer's risk profile. Let's briefly hit on ERISA. It's a long read, so I won't bore you with the details, but just note this if you are a retirement account investor. Be sure you are in your bounds because the fund may require an ERISA plan proposing to invest in the fund to represent that it and any fiduciary is responsible for the ERISA plan's investment objectives, policies and strategies. So after sorting through this prospectus, it's clear StepStone Private Credit Income Fund is aiming to fill a need for individual investors wanting a piece of the private credit action. However, the high fees, the illiquidity of the shares, heavy-handed use of leverage, along with an over-reliance to third-party partners raises significant flags. An additional risk to also bring up is that all of those benefits go out the window if Congress changes some tax code which would screw over this fund specifically. Assessment of company direction, notable opportunity and thing. You give your money to investment people to take and invest small amounts of it with the hope that you will get more in your returns that you lost paying them than if they did not exist. It's that simple. Alright, that's our breakdown of StepStone Private Credit Income Fund. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description to talk to more people such as yourself about the investment shenanigans. Thanks for watching. See you next time.